I think a lot of that uncertainty comes from people worried about how long this recovery has gone on for. And, it's certainly our view that this is the latest stages of what's been a very long recovery. But against that, we don't feel that a big cyclical downturn is imminent. So in that context, we think that investing in high yield can make sense. Now, again, at this point of the cycle, you don't want to just do that generically. You want to take a truly active approach to doing that. And so at the moment, what we're recommending is that investors look to exchange a bit of, say, duration risk for a bit more high yield risk, but do it in an active way. So what does that mean? That means a shorter duration stance. So our fund has a 2-year duration target. Against that, we're taking a very disciplined approach to stock selection. So at the moment, we have a very, very small allocation of triple Cs, and that's not going to change because fundamentally we believe if a company is triple C after 10 years of recovery, there's probably something structurally wrong with it. So being active, thinking carefully about where you invest in, and for us, that's core developed global high yield markets of the US, Europe, UK, and I have to say a little bit of Australia. But looking for high quality companies with good business models and very good cash flows, and that's a great source of return at this stage of the cycle. One of the best places, I think, to look for opportunities in high yield is look at those sectors that people dislike, because often what we see is a kind of a herding behaviour where a sector will get indiscriminately sold down. So at the moment, one of our favourite picks is actually in the auto parts sector, and certainly no part of our view on that is based on the auto market is going to start growing strongly again. Far from it. But within that universe, there's some great opportunities. There's a company we invest in, Novem, who are a small by auto parts metrics in that they have around 750 million euros a year in revenues that are growing much faster than the auto industry, because their segment, which is premium interiors, is gaining share within the car market. So therefore, we look for companies that are exposed to their own drivers for growth, not just depending on the cycle, continuing to grow. And there's lots of opportunities out there and lots of inefficiencies in global high yield for us to try and exploit.